Ben Bernanke, it looks like he's going to be retiring and a new leader will be appointed. Larry Summers has drawn himself out of the race. How do you see I think there's only one candidate that's made the news, right? I'm sure there's more. How do you see that leadership change affecting this?
So the question is about the, just to make sure everyone heard the question, which I think is a very good one. The question is about what appears to be an upcoming leadership transition at the Federal Reserve, that the current chairman of the Board of Governors and the chairman of the FOMC is Ben Bernanke. He's served since 2006, and his term will end at the end of January 2014, and then there will be a transition. The president will, like a cabinet secretary position, the cabinet will appoint someone to fill that job, and then that person will have to be confirmed by the Senate of the United States. Okay, so and as you mentioned, one of the candidates was very much in the news was Larry Summers, but he has withdrawn his name from consideration for this position. The current vice chair of the Board of Governors, Janet Yellen, has been mentioned, but other names have been mentioned as well. It's a very important job, very powerful job, and all I would say about the candidates is I think we're lucky in the United States that there are many excellent people who are interested in seem to be interested in the position or are under consideration for the position. So that's all very good news. I think that it's important, though, is not so much the person, but really the vision for strategy going forward and what we're going to be doing. The goals I described for the Federal Open Market Committee of keeping employment close to maximal and keeping inflation close to 2% are goals that the committee have adopted for itself. Very strong support in the committee for doing this in a statement that was released in January 2012 describing that our long-term goals are to keep inflation close to 2% and keep employment close to maximal. I would say that what I'm describing today is to build on that framework to make that part of our meeting-to-meeting decision-making. So if you build a strategic plan for a business, and I'm sure there's many of you who have engaged in this exercise, it's not enough just to write the plan. You have to live the plan. Every time you make a decision, you have to go back and say, okay, is this check out with the plan or not? What I'm describing is we've got these goals out there. We've got to do whatever it takes to achieve those goals on an ongoing basis. And you know, whoever that person is who steps in for Chairman Bernanke, I think having this vision for making policy, just as it's effective for businesses to have this vision, I think it would make our monetary policy making more effective. Yeah.
You talked about the growth in jobs, but we're hearing that many of the jobs that are being created are part-time jobs. Does that flavor into your argument, and what is your concern there?
So the question is about part-time workers, I've sort of documented that we've seen relatively limited growth in employment, and you're pointing out that actually a substantial part of that, or some part of that at least, is coming from growth in part-time work. Yeah, I could have shown you a picture. You know, if people are choosing to work part-time because of their own personal considerations, I mean, you know, that's their choice. But there's a number that the Bureau of Labor Statistics keeps track of that is asking people who work part-time, why are you working part-time? Would you like to work full-time if you could? And that, I would say that's shown some improvement. That is, it shot up to a very high level during the recession and has come down. But again, it shows a very slow rate of improvement relative to what's in the unemployment rate overall and certainly what we want to see. I don't think you see anything strikingly different than these pictures I've shown you in the answer to the question I just described. Yeah.
I have a sense that things have fundamentally changed in our society and economy after this Great Recession. When we talk about just by numbers saying we want to restore employment, restore jobs, I'm concerned that many of those jobs will never be there again. Here in the UP, we talk about a resurgence in mining, copper mining here in the Keweenaw. What most of us ignore is that with mechanization, we're looking at 50 to 1, 100 to 1 of employment from the 1920s in mining for what employment today would bring. And I see that in manufacturing around the country. You know, I think about what if we were faced with World War II today? Our manufacturing capability onshore is gone. Could we gear up to meet those demands? Would you comment on whether you think that our fundamentals have changed on jobs?
So I think this is a great question. The question is about have the fundamentals changed on jobs so that that we. I'm just going to ask it that way, if you don't mind. I guess you had in mind high degree of automation has played a role in changing the nature of the American workforce, and so I think we see long-term trends along those lines, going back really to the early '90s. That an economist named David Otter at the Massachusetts Institute of Technology has documented sort of the nature of the American workforce has changed. The so-called hollowing out, sort of the middle skills, not as many of those people employed. Anil, would you mind going back to the very to the second picture, the employment to population ratio picture? So I think that that question is a really good one, and it asks, where should we expect to go in this picture? What I'm suggesting is that we can do better. We can do better than we're doing right now. And the reason I know we can do better is because inflation's so low. If we're running out of workers, if the fundamental changes you're pointing to in the American workforce are there, then what we should be seeing is businesses are running up against constraints in terms of the kind of workers that are out there for them to hire. That would mean they're going to push upward on the wages they have to pay, and it's going to flow through into the inflation, the prices they charge to consumers. The picture I showed you on inflation shows that's not happening right now. I think it creates, the force you described creates uncertainties about where this picture can ultimately end up. And I think demographics alone tell us it's not going to come back here for sure, just because of the aging of the population. But we can do better. And I think by using a goal-oriented policy, the kind I described, we can do a lot better. Yeah.
I'm a little confused. You have mentioned the stimulation that you're hoping to work, but as I understand, that's like $85 billion a month that's going in, and if my math is correct, that's about $1 trillion a year. I'm but a humble farmer. I know if I keep borrowing money that I can't pay back, I don't care what the inflation rate is, at some point, I'm not going to have a farm. And I don't quite understand how this $1 trillion that we don't have is how do we pay that back?
Okay, so let me talk a little bit about the asset purchase program and how it interacts with what I'm describing. So the asset purchase program that you're discussing is that the U.S. Congress has issued a large amount of government debt, and as well, Fannie Mae and Freddie Mac have issued mortgage-backed securities, which are essentially pools of mortgages that they bought up from banks. Those are already existing, right? There's already debt out there that Congress has issued and these mortgage-backed securities. The Federal Open Market Committee goes out in an open market, competing with a bunch of other possible buyers, and buys these already issued debt and already issued mortgage-backed securities. We're buying, as you mentioned, $85 billion a month. The goal of doing that, and how are we financing that, which is an important part of this? We're financing that by crediting banks with money in their deposit accounts with us, so-called bank reserves. That's basically they have deposits with us. We just give them deposits. We use that money then to go out and buy the debt and the mortgage-backed securities we just described. So what is going on here is really a change in the nature of government liabilities. We're switching from long-term liabilities the Treasury has issued and the mortgage-backed securities, and instead, those liabilities, we're taking up those liabilities on our balance sheet, the Fed is, and then that's becoming, we're financing it by creating bank reserves. That's pushing downward. Why are we doing that? That's pushing downward on long-term yields and thereby stimulating the economy. I think that this is playing a role in helping the economy forward, but we're talking about just tactics. And I think one of the big challenges right now is that people are struggling to understand what our strategy is. What are we trying to achieve? I think by communicating a strategy, a goal for what we're trying to get to, that by itself is going to be much more informative than talking about is it going to be 85, 75, or 95 billions of dollars. The other piece of policy we have in place is our the Fed funds rate, the interest rate that the interbank lending rate that we target, and we're targeting that very low. A key question people want to know is, when is that going to go up? I mean, I get that. Maybe I get asked that more than other people in this room, but I get that asked a lot. And that's the kind of question I'm trying to answer for people, is to say, we're in this to keep, for the so to speak, for the long haul, and we're going to keep accommodation in place until we see a faster return to employment, as long as we keep inflation near 2%. So I think that I think a lot of the discussion of monetary policy, and the question you ask is one that I get all the time, is really about the tactical moves the Fed is making on an ongoing basis. But what we have to establish is a better strategic context for people to understand what those moves are. And that framework alone will provide a lot of stimulus, just as it did for Chairman Volcker in helping him solve his problem of high inflation. Getting the framework in place for people to understand where we're going helped reduce inflation into itself. Yeah.
If I segueing off of that, if I understand your point about cautious optimism correctly, we're at a point where Fed funds rate is near record lows. Lenders are hesitant to lend, business owners are hesitant to expand. What is the trigger that is going to get you to that strategic goal of the expectation changing and businesses taking on risk and expanding and creating those jobs?
Yeah, there's a little bit of a chicken and the egg problem that I'm trying to solve by using monetary policy. So my colleague, President Dudley of the New York Fed, referred to a chicken and egg problem that if you don't have demand for your products, you're not hiring. If you're not hiring, then people don't have money to spend, and so now you have a problem. But part of what's holding that back is uncertainties about how the Fed will respond to the economy as it does improve. Are we going to be satisfied if the non-farm payroll number suddenly ticks up to 200,000? Is that good enough for us in terms of what we want to see? If it is, that implies one path for people in terms of what kind of interest rates they should be thinking about and what kind of demand for products that businesses should be thinking about. Because by raising interest rates or by starting to cut back on monetary stimulus more generally, we can slow down the rate of recovery of the economy. What I'm suggesting is we should be communicating more effectively that we're about having the economy recover as fast as possible, as long as inflation stays close to, possibly temporarily above, but close to 2%. There's a question at the very back, and I'll come back to you. Yeah.
Do you feel that the Fed should have a little more power, a little more comment to Congress and President about the fiscal issues? I know you try to stay separate. Do you think that maybe you should be more vocal about that?
So the question is about whether or not the Fed should be more vocal in commenting on the fiscal situation. You know, I think that I think we've given appropriate guidance on that point in in public remarks. I'll speak for myself, but what I've said, and I guess by definition I feel that's the appropriate, by pointing to the fact that I think it would be useful. There's a long-term fiscal disconnect in this country. It's not a short-term one. It's a long-term one. By long-term, I mean something that's going to manifest itself over the next 10 years or so. And that's driven by demographics. We have a lot of obligations to our older citizens. More of us are going to get older. And that's going to put pressure on, we're going to have to cut spending or raise taxes in order to deal with those obligations. The one piece of good news that's happened on that front, just by data point, is that health costs seem to be rising more slowly over the last couple of years. And that, you absolutely don't want to extrapolate from 2 years or so, but that would be very good news if that continued, because that would really help ease those pressures. But what I've asked for is more clarity about how that resolution is going to take place. Is it going to be through cutting taxes, or by raising taxes or cutting spending? I think the chairman, actually, Chairman Bernanke, has been more direct in his remarks about Congress. I have to say that we we are a creature of Congress. The Federal Reserve is a creature of Congress. We're created by the Federal Reserve Act. We are given a tremendous independence with which to operate to achieve our goals, and which is desirable and good, but that's a privilege. It's a privilege granted to us by Congress. I think that I would be, by myself, I just feel instinctively, I should be cautious in criticizing the very body that's created these privileges for us, because they don't have to give us those privileges. So, yeah.
Mine was a historic question, if there's a good answer for it. Traditionally, understanding that every administration is different and that politics is somewhat a strange beast, do recommendations or candidates for the chairman's position typically originate somewhere like Treasury, or could they come from anywhere?
I think, so the question is about where do candidates for the Fed chairmanship come from? I think there's just, people have come to it with a relatively broad range of experiences historically. So I don't think there's any right answer to that question at all. It's just, people have come to it, as I said, with a relatively broad range of experiences.
How do we expect, this kind of goes to the farm question, how do we expect business leaders and consumers to take on risk and be optimistic when they look at the issue with federal spending and the federal debt and look and say that at the macro level the government is not doing the things that we know that at micro levels are necessary for survival?
Yeah, so I think it's important though, I think the communication on this issue of the challenges of the fiscal situation for the federal government, it's important to separate, and Chairman Bernanke does a great job of this when he talks about this, is to separate out short-term versus long-term issues. So we had a very big run-up in the deficit during the recession, that gray shaded area, and it continued afterwards. But that was simply, essentially, the natural workings of low tax revenues and the use of transfer payments to help support people who were going through tough times during the recession. As the recovery takes more hold, even the slow recovery we're seeing, you're going to see declines in the deficit. And the Congressional Budget Office has great projections on this. You can see that there. And there's a danger in that, actually, is that people are going to start to, there's a danger people are going to start to feel comfortable with the fiscal situation just because the current deficit is declining. It's really the longer term issue of what's going to happen demographically down the road that's really the key point. It's not important, it's important for us to talk about that now and start to think about it. And actually you see those conversations, they're maybe a little more heated than I would like, but you start to see those conversations in Congress and with the President. It's also, the fact those conversations taking place right now is why U.S. government debt continues to trade at very high prices. People have confidence in our ability as a people to resolve this issue. So I think it's important not to conflate the short-term run-up in the deficit that we saw, and now what's going to be a short-term fall in the deficit, with really what's going on in the long-term structural issue that we do have to solve. I think that you're more on top of this than I am, but I think most business leaders are not necessarily looking at what's going to happen in the next decade. It's really over the shorter time frame that's important.
Yeah, would extending the horizon of the bond program or boosting the size of the purchases help the job market?
So I think that what I'm trying to describe today is more focused on a strategic framework for thinking about the bond program and all our actions and communications.
Let's give him a hand.
Okay. Thank you very much.